Hello, everyone. I'm going to start in a minute or so. Adam Bergman, IRA Financial. I'm going to do a Q&A period on unrelated business taxable income. This is a follow-up from a previous webinar of a few weeks ago. I got hundreds of questions, so I tried to condense them into 30 or so questions that I thought best summarized people's general questions on the topic. So I'm going to give it another minute or so for people to kind of get organized, get a chance to log in, and we'll start in a couple minutes. We had a huge turnout for the last webinar. So obviously this is an area where people have a lot of interest in. People are obviously somewhat not confused, but maybe have need further clarification on a lot of these issues, because it's not something that a lot of attorneys, CPAs, accountants, tax professionals have a lot of information on, mostly because UBTI applies to charities or retirement accounts. And if you don't deal in those worlds, you're not going to come across UBTI, because UBTI doesn't generally impact taxpayers, corporations, individuals, unless you're a charity or a retirement account. So that's why there's a lot of tax professionals that just don't have a lot of knowledge or foundation in this area. And that's something that I'm hopefully able to add some clarity, able to help some of you kind of navigate these rules. That's my goal, is to add support to all my clients as best as I can to help everyone make tax efficient investments, understand all the rules, so you guys can worry about making the right investment and not worrying about the IRS. So I am going to start right now. This is my bio. I think everyone knows a little bit about me. I'm the president of IRA Financial, IRA Financial Trust. I'm a former tax attorney. I worked almost 10 years in New York City at major law firms as a tax attorney, written 7 books on self-directed retirement accounts. And this is my love, my passion, my dedication. This is what I love to do. I love to talk to clients, to all you guys, and help educate people about all the rules, regulations involved in the self-directed retirement world. And that's what I want to do today. Today, I want to talk about, obviously, it's a Q&A on UBTI and UDFI. I want to talk about that because, again, there are a lot of questions that I get. That's probably the most, that and prohibited transactions are probably the 2 main questions I get from clients. So I wanted to spend some time on a Q&A because I got some great questions. I mean, the people, I think I had 500 or so people that listened or watched the last webinar, and I got some amazing questions. So before I get into the questions, let's just do a quick summary of what is unrelated business taxable income, or unrelated taxable income, unrelated debt finance income. It's all really the same thing. Basically, it is triggered in 3 ways. That's it. 3 ways. Number 1, use margin of buy stock. Number 2, use a non-recourse loan to purchase real estate. And it has to be non-recourse because you can't take a traditional mortgage and buy real estate, because that triggers the prohibited transaction rules under 4975C. So that's something you just can't do anyways. And then the third is you invest your retirement funds into an active business like a restaurant that's operated through a pass-through entity like an LLC or partnership. If you buy public stock like Apple, Google, Ford, GE, you're not going to get UBTI. Why? Because they're C corporations. C corporation, think of it as a big box. It blocks in all the income from flowing up to the shareholder, because the C corp pays its own corporate tax. So there's no UBTI because the corporation pays its own tax. So there's no tax to capture because it's already being captured. So if you are not using margin to buy stock, you're not using a non-recourse loan to buy real estate through an IRA, there's an exception for a 401k. So if you use a non-recourse loan to buy real estate in a 401k, you can do it without triggering the prohibited transaction rules under 514C9. And thirdly, if you invest in an active trader business with an IRA or 401k, like a restaurant that's operated as a pass-through entity like an LLC, you may have UBTI.
Okay, and when I say maybe, it's because you need $1,000 of net income. If it's under $1,000, you don't have to report it. Over $1,000, you will be likely subject to tax. The tax rate could go as high as 37% in 2019. However, you can take into account a pro rata share of deductions, depreciation, expenses, and also NOLs, net operating losses from prior years. So in a lot of cases, especially in real estate, the first couple of years, there's generally not a lot of profit because of the depreciation expenses, debt service payments. Only later on does the venture become profitable, and at that point, you're able to use some of the NOLs or net operating losses that were allocated to you to reduce the UBTI. You don't have to file a 990T to capture those losses. You just got to take them into account, and then you can report them on the 990T to offset the gain in later years, which is very helpful. So again, all in all, 3 ways to trigger UBTI. I'm just going to focus on it one last time before we jump into some of the questions. Margin to buy stock, non-recourse loan for real estate and an IRA, exception for a 401k, and invest in an active trader business like a consulting firm, restaurant, retail store that's operated through a pass-through entity like an LLC. Okay, let's get to some of the exceptions. Most every other source of income that I didn't mention, other than those 3 transactions, will not trigger UBIT. Dividends, interest, annuities, royalties, rental income from real estate with no leverage. So if you buy and sell stock, buy and sell real estate without leverage, get dividends from stock, interest from a loan, no UBTI. Okay, you don't have to worry about UBTI, just forget about it. Only worry about UBTI, again, 3 ways: UBTI, margin to buy stock, non-recourse loan for real estate and an IRA, invest in an active trader business through an LLC, not a C Corp. If you buy public company stock or any stock of a C Corp, you will not have UBTI. The UBTI tax rate, as I mentioned, it starts getting triggered. The first $1,000 you don't even have to report a 990T. Once you go from 0 to 2,600, you got about 10%. And then once you're over $12,751 in income, $3,000 plus the 37% over 12.7. So once you're around 15 or so thousand, you're going to be at the highest tax rate. So very low threshold, obviously, right? The corporate tax rate is only 21%. The individual tax rate is 37%, but it's triggered at a much higher level. So that's something to just consider. You don't want to be involved in UBTI. You want to try to find a way to structure investments in a way that does not trigger UBTI. So again, we went through this. There's some examples. You invest in an active trader business that's operated through an LLC in your using IRA or 401k funds. The rest, it's a convenience store or manufacturing business. If there's $1,000 or more profit allocated to your IRA or 401k, you got UBTI. What happens if you invest in a private equity fund, right, that invests, or a venture capital fund that invests in operating businesses that are LLCs or pass-through entities? You may get triggered with UBIT. So that's something you're just going to have to ask the general partner or the promoter to find out what's going on in that fund. If there's leverage being used and there's going to be business investments that are made through pass-through entities like an LLC, you could have UBIT. A lot of venture capital firms, private equity firms will invest in C Corps in some degree because they don't want the losses and also the UBIT to go up to the investor. So that's something you may just need to deal with and talk to the promoter or general partner about the UBTI application. Why? Because in most cases, you're just going to get a K1 at the end of the day that will either tell you there's UBTI or not. Usually it's a code V under other income, V as in Victor, that will tell you if there's UBTI. A lot of cases, the promoter is not even going to give you any indication, and then you're kind of left up to your own free will to figure out whether UBTI applies, and often it's almost impossible, and which leaves the investors in a very tight spot. How do you avoid UBTI, UDFI? C Corp blocker, right? Before 2017, before the Trump tax rate, the C Corp blocker didn't really work. Why? Corporate tax rate was 35%. UBTI tax rate at that point was 39%. 4%, it's not a huge deal. If you're going to have less than millions of dollars of net income, the 4% doesn't really matter on $100,000. Maybe not worth the cost. Another way to do it is loan versus equity investment, right? If you invest in a restaurant that's operated through an LLC,
it's going to trigger the UBIT. If you lent the company money and just got interest back, 8%, 10%, 15%, whatever, as long as you don't violate state loan sharking rules, you don't have to worry about UBTI, right? Because interest is exempt from the UBTI tax regime. But if you are a loan or a debt holder versus an equity investor, your upside's limited, right? You're only going to get that interest. You're going to get your principal back plus 6%, 8%, 10%, whatever the stated interest back is. Whereas an equity investor, if you invested as an early stage investor into Uber, you're probably going to make a lot more money than if you just lent Uber $100,000 at 8%. So that's kind of what you got to balance. So let's get to some Q&As, okay? I got a lot of them, so I'm going to try to jump through as many as I can. If people have more questions, just type them in and I'll get to them if I may. If I can't get to them, I will answer them. You can send them to info@IRA Financial or just type them in, and I'll try to do a blog answering the questions. Number one, is there a difference between UBTI and UDFI? Really, ultimately, big picture, no. They both trigger that 37% tax. UDFI really just focuses on debt finance income, real estate acquisition indebtedness, and UBTI really tackles the two other, margin of buy stock and investment in active trader business. Really, they're both subject to the same 37% tax. UBTI is really 511, 12, 13 of the tax code. UDFI is 514. But really, at the end of the day, same thing because you're triggering the same tax. Two is income from an oil and gas project subject to UBTI. Good question. In general, in most cases, yes. Like master limited partnerships that invest in oil and gas, generally you have a working capital interest in them, and generally it's going to be considered a business. Usually they're operated through pass-through entities like limited partnerships. Therefore, you're most likely going to have UBTI if you use an IRA or 401k to make the investment. There also could be debt, underlying debt. Whereas if it's just a royalty payment and not a working interest means that you're actually like a partner. You may have to contribute more money. You're subject to losses. You are considered having an interest in the venture. UBTI will be triggered based off that premise, whereas royalty payments is more passive. You're just getting X percentage of an income stream, for example. That would not be subject to UBIT. Based on my experience, most oil and gas investments, MLP type investments, are subject to UBTI. That's why in a lot of cases they may not be best suited for retirement accounts. If you use personal funds, non-retirement funds to invest in the oil and gas project, you may not be hit with UBTI. You may save yourself 37%. Plus, if you did it with personal funds, there's a whole idea of return of capital on the investment, and you can circumvent some of the income rules. So generally, oil and gas, unless you're getting royalties, if you're going to have a working capital interest or working interest in the project, you may want to think twice about using retirement money. 3, when investing in a business via pass-through entity, LLC, if the IRA is not involved with selling goods or services being performed, would UBTI still be triggered? The IRA is more or less a passive investor. So yes, unfortunately, anytime an IRA invests, whether it's an LLC, a corporation, an LLC is not a person. So it's always going to be technically passive, right? An IRA can't provide services anyways. It's not a person. It's a retirement account. It's not even tangible, right? It's something that's intangible and is not able. It's not a living organism or mechanism. It's just an account. So whether you're investing in Apple or a restaurant, local coffee shop, it's always going to be passive. So you're not going to necessarily have to look at whether the IRA is personally involved. You have to look at what the activity is. If the activity is a business that's operated through an LLC or other pass-through entity, you generate more than $1,000 of income, you're going to have UBIT. Okay, so that's just something to keep in mind. You could use NOLs, net operating losses, to offset it, but you're going to have UBIT. So even if the IRA is always going to be passive, again, right? The IRA is not going to be serving the coffee or making the cappuccino. It's always just going to be an investor. So that's not really the relevant point of analysis. The relevant point of analysis is what is going on in the business. Is it a business, first of all? Are you making widgets, or are you just getting interest off a loan, which is passive, or you're just selling stock, which is passive? Are you just maybe selling one home? That's passive versus selling 100,000 million widgets, which is a business. Business triggers UBIT. Passive generally does not trigger UBIT unless there's leverage. So again, it's always going to be passive. You're just going to have to look at what the business is doing. Is it a business, and is it an LLC or not? Next question. My single member LLC owned by an IRA owns a convertible note which earns interest at a 15% annual rate, known as a loan to an active business, C Corp, through my LLC. It is my understanding that my pass-through LLC is not required to file a 990T on the interest income. Further, I would not be required to file on the note conversion into equity until I receive dividends or other income directly from the active business based on profits. Am I right? So let's look at a couple things. So you have an IRA LLC, okay, that invests in a C Corp. So how is UBTI triggered? Three things, right? Margin to buy stock? No, we don't have it here. Non-recourse loan to buy real estate? No, we don't have it here. Invest in an active trader business? We have that here. But is the active trader business operated through a pass-through entity like an LLC? No, we have a C Corp. Remember, C Corps block UBIT. So once you see C Corp, I'm moving on. I'm done. I don't care if there's leverage. I don't care what's going on if it's a business or not. I'm moving on. I don't have to deal with UBIT because I got my C Corp there. So the C Corp is kind of like the rose you want to look for. It's that beautiful image you want to look for to make you smile and say, okay, I see that C Corp there. I'm moving on. I don't have to deal with my UBTI analysis anymore. Next question. If I invest in a C Corp through my LLC, if I invest in a C Corp through my own LLC pass-through entity, is income paid to my entity dividends or other exempt from UBTI? So yeah, same thing. C Corps pay dividends, right? Partnerships, LLCs, you can get distributions or profit allocation. C Corp, you get your money through selling stock or dividends from retained earnings. Anytime you get a dividend from a C Corp, it's exempt from tax under 512. You got to do that analysis again. Is it margin to buy stock? No. Non-recourse loan to buy real estate? No. Invest in an active trader business through a pass-through entity, LLC? No. Your LLC is investing in a C Corp. You got to look at what the investment is. I'm investing in a C Corp. I'm good. Dividends, interest, whatever I'm getting from my C Corp, exempt from UBTI. I don't have to worry about it. If in this example, your IRA LLC was investing in another LLC that, let's say, was selling flowers or selling chairs or a consulting business or accounting firm or a software company, then yes, you could have UBIT if there's more than $1,000 of profit that's allocated to you. I expect to flip 4 homes this year. Do you think that will trigger UBIT? So that's a great question. So I want to get, I'm happy someone asked this question because this is something that I deal with on a daily basis. Is an activity a business or not? And that's the $1 million question. And I'm embarrassed to tell you I don't have an answer. And no one has an answer. IRS Agent 1, IRS Agent 2, IRS Agent 3 will probably come up with different answers. There's no set threshold that once you pass into that world, you are in the UBTI universe. Okay, it's not like you get you're playing a basketball game and you make the basket and you get 2 points and that's just the way the rules are. It's not like that. You can flip 2 homes, 3 homes, 4 homes, 15, 30. The facts and circumstances will dictate whether this is a business or not. If you're a retired doctor and you flip 4 homes and you're doing very minor improvements and you do other things with your retirement funds, you buy stocks, this is just a diversification play, you're probably not in business. What happens if you're a real estate developer or you're in the real estate world personally, you're flipping 4 homes, this is all you do, spend all your time on this stuff? Is that a business? Some may say, hey, that looks like it could be a business. An IRS agent may say yes, may say no. There's a couple factors the IRS look at, and this is something I went through in the first webinar, and I don't really want to go into so much detail, but just to summarize, they look at frequency, how many you're doing, intent, do you want to be in business or not, personal experience, what do you do personally? Are you a lawyer, doctor, teacher, or a real estate flipper? Timing, are you buying a house, flipping it, buying another one a day later, flipping it, buying another one a day later?
level of improvements? Are you buying a house, painting the fence and selling it? Or are you building, you're buying a piece of land and putting 8 homes on it? These are all the things the IRS would look at to determine whether you're in business or not. Again, I always tell clients, you could pay me $1 million for my advice. I'm not going to be able to give you a definitive answer. Because if you do get audited, the first agent may say this is UBTI, the second one may say no, the third one may agree with the first one. You just don't know. So how do you minimize the risk? Well, number one, you want to show diversification. You want to show this real estate activity is just part of your overall retirement investment strategy. You want to have as much time between flips as possible. You want to hire third-party contractors to do all the work possible. You want to show this as passive. You want to show your intent is not to have a business. And you also want to show that, again, this is part of the overall investment strategy, that I'm going to sell a home, put that money, maybe buy some stocks. A couple months later, maybe I'll look for a new property, move my money from the stocks into real estate, or take 80% of that money and buy real estate, 20% into stocks, maybe 5% into hard money loans, precious metals. I mean, you just want to show that the real estate's part of the equation. But again, I wish there was a definitive number, like, hey, if you do less than 6, you're good, or more than 6, you're not good. But there's not. It all comes down to facts and circumstances. And I spent a good amount of time in the previous webinar discussing some of the cases that talked about this and some of the framework and analysis. But it's just something you got to get comfortable with. That's why we're here. That's why the specialists at IRA Financial are here to help you. We can help give you some type of, say, advice, but at least help you navigate the rules, let you know what cases say, what you can do to minimize risk, and what some of our clients have dealt with. Okay, the next one's a good one. I had losses in the first 3 years of my real estate investment. It includes a non-recourse loan. Next year, I expect some profit. My question is, will I be able to use any of the losses to offset my UBTI? So yeah, the good question, as I just talked about it earlier, yes. The IRS isn't as mean as we all think. They understand that if you are going to pay tax, they're going to have to give you the benefit of those losses. They're going to have to treat the IRA as a taxpayer, like any other taxpayer that gets to use losses to offset future income. So the good news is you don't have to file a 990T, which is the form where you report your UBTI income if you have losses. If you have under $1,000 of UBTI, you don't have to file a 990T. So if you lost 20,000 bucks, you clearly don't have to file a 990T. The instructions say so. Some clients of mine still want to file the 990T. They don't trust the IRS instructions. They don't trust that the IRS will give them credit for the losses, and they file it. And I guess there's nothing wrong with it. I'm not sure. I haven't had any feedback from the IRS of what they've done with these forms over the last couple of years that I've heard about people filing 990Ts with no income. I'm assuming they probably don't do much with them, but it's not necessary. The instructions are clear that you do not need to file the 990T if there's less than $1,000 of income. The instructions also say it's clear that you can get use of those losses and you will not lose them if you do not file the 990T. So yes, you can avail yourself of those losses. Hopefully it will reduce your UBTI to nothing, and whatever it doesn't reduce, then you have to pay that on the 990T for your IRA investment, but you do get to offset those potential income or gains with past losses. If I have net operating losses, do I still have to file the 990T? Okay, so I just addressed this. No, you don't have to file it. The instructions are clear that you can retain the losses without filing the 990T. Don't worry, they're not going to disappear. How do I determine if I should use a C Corp to block the UBTI? So this is a great question. This started becoming relevant last year after the Tax Jobs Act, Tax Act, President Trump signed, that reduced the corporate tax rate from 35 to 21%. Now there's some analysis that needs to go in whether it makes sense to do a blocker, right? Why do you want to do a blocker? You want to do a blocker because you want to reduce the 37% tax on the $100,000 of net income that's allocated to you from your IRA restaurant investment, and you want to reduce that 37% tax to 21%. That makes sense, right? Yes or no? It may. It may not, because you got the C Corp 21% taxes on all the profits of the investment, right? If you invest $100,000 into a C Corp and there's $100,000 of profit, you're going to pay 21% or $21,000 on the profit that the C Corp generated. Then any dividends can go back to the retirement account without tax, but the C Corp will pay a tax. Now, if you're $100,000, if you invested in someone's restaurant and you generate $100,000 in net income from the UBTI, you'd pay 37% or $37,000. So clearly, in that case, the C Corp blocker makes some sense, right? 21% is better than 37%. 21,000 is less than 37,000. But what about this? What happens if you used $100,000 from your IRA to buy real estate and you took a loan for $100,000? So now you have a debt to equity ratio of 50-50, right? You used $50,000 cash, you borrow $50,000. So you have debt equity ratio of 50-50. You're only going to pay UBTI tax on the 50% of the debt. So if you generate $100,000 of net income, $50,000 of that, not the 100, but the $50,000, which mirrors the debt percentage, would be subject to the UBTI tax. You'd also be able to take into account your pro rata share of deductions, expenses, depreciation. So maybe that comes down, let's say, to 40,000. Maybe you're paying 37% of 40,000, which let's say is 15,000 bucks, okay? Versus if you did the C Corp blocker, you pay 21% of 100,000, right? Because the C Corp pays tax on all the profits, and now you're paying 21,000 if you use the blocker versus 15 if you didn't use the blocker. So that's why it's more number crunching than just saying, oh, yeah, I'm just going to use the blocker for every occurrence. You got to really do the analysis. That's kind of where I think one of the reasons clients like using our annual compliance service is the kind of help that we can offer. We can help you address questions. We can help shed light on certain issues. We can help bring to light other issues you may not be thinking about and help you hopefully structure an investment in the most tax efficient manner. I think our annual fee is $199 bucks. I'm like, where else are you going to get advice like this for $200? Like, it always drives me crazy when some clients are just like, oh, I don't want to pay about 200 bucks. And thankfully, it's only a small group of people, but I'm just like, and they're like, oh, I'll be able to figure out these questions on my own. I'll just ask an accountant or lawyer. And I'm like, I don't know any good lawyer that's going to give you any good advice for less than 200 bucks. And if they're willing to give you advice for less than 200 bucks, I don't know if I'd go to them. So it's just, it boggles my mind, especially when an analysis like this can save you thousands of dollars and hundreds of thousands of dollars if you're talking about big numbers. So for real estate investors, if the higher the debt portion used, probably the more sense a C Corp blocker makes. If the debt portion's really low, then it may not make as much sense because you're only paying UBTI tax on the debt portion. So that's just something to think about. Next question. I don't understand. How am I supposed to know if the fund I invested in will be using leverage or investing in a pass-through business? So it's a great question. Another one that I get really often. Thanks again for all these questions. I really appreciate it. It makes my life a lot easier, kind of have client questions that I can address instead of making them up on my own. So I get this question, hey, I'm investing in Fund A, Fund B, Fund C. I think they're doing equity investments, but I have no idea if they're using margin. I have no idea if they're using leverage. Or I'm investing in this venture capital fund. I have no idea if they're investing through pass-through entities, corps. I'm investing in this private equity fund, same analysis. I have no idea. Okay, first response is you should have some information from the promoter. There should be a private placement memorandum, PPM. There should be some information. I'm not expecting anyone to read 50, 60, 70 pages of some of that document or the legal jargon, but you should look at it because the investment strategy is in there. Generally detailed, and you may want to do an edit find for the word unrelated business taxable income, because a lot of times good PPMs will talk about if you're a retirement investor, there could be the risk of UBTI because we may use leverage or we may invest in active trader businesses. You'll see something about plan asset rules. If more than 25% of the fund will be pension investors. Some funds will say, we will do everything in our power not to trigger UBTI. We're not going to allow for plan asset rules to be triggered. We're not going to allow for more than 25% of the fund to be pension investors. We're not going to use leverage, or we're not going to trigger UBIT. And I've worked on deals as a lawyer where I've seen language on both ends, some open-ended, and some saying, we guarantee we're not going to trigger UBIT. So the private placement memorandum, the legal documentation, the subscription documentation, probably not the operating agreement, but more the memorandums, the PPMs, will talk about the investment strategy and talk about some of the risks and some of the taxes that could be triggered. That's where I would go. Talk to your promoter. They want your money. They're going to hopefully give you good details in the investment strategy. And hopefully they want to make the investment as tax efficient as possible. But sometimes promoters don't know, the investment strategy changes. So just, you don't have to read every word in the PPM, but just do some edit finds for unrelated business taxable income, unrelated debt finance income, plan asset rules, retirement accounts, pension, IRA, 401k, and you'll get into the right section. And then you can kind of do a little research. If you're a client of ours, you can talk to us about that, we can help you look at the documents to kind of get a better idea of what your risk is. But a lot of times you don't know. A lot of times the promoter doesn't even know your retirement account, right? If you're using an LLC, if your LLC is owned by an IRA, the promoter may not know. Now, good funds, private equity, the bigger ones, private equity hedge funds, and subscription documents or the accredited investor documentation, they're going to make you provide information on the actual beneficial owner of the investment. So even though you're using an LLC or a trust, let's say, they're going to want to know who the beneficial owner is. Is it an IRA that owns the LLC? Is it a company? Is it a trust? Is it an individual? Based off your response, if it's an IRA, you may get into some questions that address UBTI. If you sign up as a 401k, the promoter should see the word 401k, and that should trigger responses about UBTI or potential other tax ramifications, something to just ask about, think about, because in some cases you're going to get a K1 and there's not going to be a code V for other income on the bottom right of the form, and you're not going to know if there's UBTI, and it's likely not your fault. So if you don't know, how are you supposed to report it? That's a problem, right? You can't report it if you don't know. Can you technically get audited if you don't know? Yes, but your 990T is not going to get audited, right? Because you're not going to file the 990T. So what happens if your IRA gets audited? You get a smart IRS agent and says, hey, you invested in this fund, was any leverage used? Or were there investments in a pass-through business? The answer is yes. They may say, well, where's your 990T? So, oh, I never filed it. I didn't know. And then they'll say, well, you should have known. Look at the document, or let's get some information from the promoter. And you may get into just some weeds, some issues you don't want to address. So think about it. Ask before you invest. You should get some good information. So how little self-employment income can I get away with to establish a solo K so I can get around UBIT? Great question. So a lot of people, especially real estate investors, they want the solo K to avail themselves of 514c9 and get around paying tax on UBTI. So how do you get into a solo K? You need to have some self-employment income, right? It doesn't have to be, you don't have to create the next Uber or the next Tesla, but you need to have some self-employment income. So you either have to generate, whether you're a math tutor, whether you're mowing someone's lawn, whether you're selling shoes on eBay, whether you're doing social media, setting people's websites up, teaching people piano, doesn't matter. I have a client that's a Santa Claus for a month a year and generates a couple $1,000, files a Schedule C, that's self-employment income. So it could be anything. It doesn't have to be your full-time job. You just have to have a business. Okay, so it has to be a business. So you need to have your activity rise to the level of a business. You can't be collectibles. You can't be trading stamps. Well, I guess stamps isn't, that's maybe how old I am. I actually had a stamp collection when I was younger. I guess most people now don't use stamps. But like baseball cards, it's probably not a business. But if you sell stuff on eBay or you're an influencer and you get paid for wearing Gucci sneakers, great, that's a business. As long as you have a business and you have no full-time employees, so just you and another business partner or an independent contractor, not another person that works more than 1,000 hours, you can set up your own solo K. And the beauty of the solo K is you then can use leverage, non-recourse loan to buy real estate and not trigger UBIT.
which is great because you can super leverage your 401k plan. So let's say you can get put $20,000 of 401k, borrows $80,000, buy a home for 100, flip it for 200, and now you've just been able to put 100. You pay off your loan of 80,000, and that $100,000 goes back into your retirement account. So you're able to buy a house for 100 and only put 20,000 down. If you did an IRA, 37% tax on your gains. If you did in a 401k, no tax. So anytime smart people see discrepancies or inefficiencies in the market, which here you have an inefficiency, you have or two retirement accounts that do the same thing that are taxed differently. Smart people like to take advantage of that, just like capital gains versus ordinary income, 15% versus 37%. Smart people, that's why most of the rich people out there, so a lot of the Democratic candidates like Elizabeth Warren, they're talking about wealth taxes. It's not really going to do much because the rich people, they don't get paid. Their wealth comes from capital gains investments like hedge funds, selling stock, selling real estate, not from ordinary income. People want to reduce their ordinary income. They want to increase their capital gains to either 15 or 20% and not pay 37% on their income. So wealth tax that doesn't include capital gains is not going to do anything. It's a waste of time. I don't know why more people don't see that. Maybe I'm a tax lawyer and they're just don't understand how the rules work. But I look for inefficiencies. Smart investors look for inefficiencies in the market. Here you have a situation where there's an inefficiency. There's the same type of investment, okay, that has two different tax consequences based off the retirement account used, IRA or 401k. There's really no justification for it. Legislative history is not clear on why 401ks have this benefit, IRAs don't. But smart people want to take advantage of it. Smart people still need to make sure they avail themselves of the rules and make sure they're eligible for a solo K. If you are eligible for a solo K, get involved, try to set it up versus an IRA if you're using acquisition and indebtedness for real estate. Okay, if you use margin to buy stock or you're investing in a pass-through business like a restaurant, it's not going to help you. The exception only applies to real estate acquisition and indebtedness. So if you can get into a solo K and you're a real estate person and you're going to use leverage, jump on it. It's an amazing, amazing win-win, very tax efficient strategy. How do I get a non-recourse loan? Great question. So most lenders out there are going to want 30, 35% down. I do have clients that have good relationship with hard money lenders. I can put 1%, 5% down on the right property. But most of my clients are going to go through a bank, traditional non-recourse lenders. And if you want names of lenders, let us know. You can email your specialist or email me or email info. We'll send you a bunch of lenders we work with. Try a local bank. You're going to pay a couple points more. Why? The bank's taking a bigger risk because it's a non-recourse loan, meaning if you default, all the bank can do is go after the underlying assets, securing the loan, the property. It can't put you into bankruptcy. It can't go after your cat, your dog, your car. All it can do is just get the underlying asset. So that's why non-recourse loans are a little bit pricier to get, but they're available. We got a bunch of lender partners that we work with helping serve our client base. You can try a traditional financial institution as well. So the opportunity is there. Again, if you use the solo K instead of the IRA, you'll get around paying the UBIT, which is really good. Does buying and selling options trigger UBTI? So generally, no. Believe it or not, there is an exception under the 512 regs about option contracts, and that's not considered traditional margin, like using a loan to buy stock. And when you're buying and selling options or selling option contracts, it's generally more of a capital gain transaction, and it's not a debt arrangement, and it's not considered UBIT. So that's a good thing. Mining crypto. So for all those cryptos investors, and it's crypto market has kind of stabilized. It's Bitcoin's over 5,300. So people are kind of getting back into mining. Mining is obviously how you authenticate transactions, and if you solve these complex algorithms, or at least your computer does, you get rewarded through Bitcoin, for example, or whatever crypto you're mining. Crypto mining is a business. It does trigger UBIT, okay? It's like owning a restaurant, selling cappuccinos or pizza. It's a widget, it's a product, and it's a business, and it does trigger UBIT. So if you are mining cryptos, beware of that. You may want to look at the C Corp blocker to reduce your tax to 21%, assuming you have profit. Just want to confirm, if I buy and rent out a rental home to a third party, would I be subject to UBIT if I do not use any debt or pay cash? So it's a good refresher question. No, you will not have UBIT if you do not use debt, you do not use margin by stock, and you do not invest in an active business through an LLC. So if you rent out a house, you bought a house for $150,000, you rent it to a non-disqualified person, a non-family member, a non-lineal descendant, and you get X amount of rent back into your IRA or 401k each month, that is not subject to UBTI. That is your run-of-the-mill self-directed investment, super easy, safe, and from a UBTI perspective, of course, and you don't have to ever deal with UBIT. Okay, if I invest in a hedge fund that is just trading equities and debt, but uses leverage, will that trigger UBIT? So yes, that will, and let's run that analysis. Margin by stock, right? That's probably margin by stock, right? You're using a loan to buy equities or a loan to do transactions. So that's going to fall under the first category, and you probably are going to have UBIT. It's not going to matter if you're an IRA or 401k. The UBIT application will apply either way. Where on the K1 would I know the amount of UBTI? So that's generally box 20, I believe, other income. It's usually a code V as in Victor. Every year they change the code, so take a look at that. But that's where you will be notified if there's UBTI. There's always other codes there, like 199.8 code. I've seen code Z, code AA, all weird codes. But if you see a V as in Victor, then your eyes should open up and you should start looking at 990T related matters. I'm purchasing a condo in a building that will be operated like a hotel. Would I be subject to UBIT? So great question. I actually did a podcast about this that will be posted shortly. It's going to go live in the next couple of days about Airbnb investments, which are pretty hot. The Airbnb investments are generally not subject to UBTI. Why? Because Airbnb type daily, weekly, monthly rentals, even though it's not an annual type of lease, it's still considered rental income because of the fact that it's not a hotel. So the determining factor of whether a Airbnb or one of these daily rental type investments would be, or short-term investment rental properties, I should say, would be subject to UBTI is really your services being performed on a nightly basis. So if you're not giving turn down service or maid service, and you're just giving basic services like air, hot water, cold water, electricity, internet, like stuff that everyone needs, no one's going to rent a room without it, or an apartment, or a house, then you're not going to be subject to UBIT, assuming there's no debt, right? It's like renting a piece of property, even if it's daily or weekly, even if it's a vacation spot. You can't use it personally. Obviously, that would trigger a prohibited transaction. But if you're not doing turn down service or maid service, you're not going to be treated as a hotel, even if the facility has a pool or a spa or even concierge service or even a daily or a 24-hour room service facility. You're not going to be likely treated as a hotel because you're not giving them hotel services such as maid service. So that's really the big distinction. If you're just doing an Airbnb, they pay you $200 a night. You give them the keys, clean sheets. Obviously, you're not putting anything in the fridge. You're giving them just the basic utilities, and they're on their own. It's just like renting someone an apartment, even though it's less than a year and it's daily or short term, it's rental and not subject to UBTI. But if for some reason you're giving them maid service and butler service or whatever you're going to give them, that looks more like a hotel, that's in addition to just what any other renter would get from a building. So if I rented an apartment when I lived in New York City for many years. The apartment had a concierge, it had a gym. It didn't have room service. I wish it did, but it had a gym that came with the rent. So I paid my landlord rent, and I'm sure the landlord, if he owned the unit in a retirement account, would not have paid UBTI. Right? He didn't give me maid service. I just paid him rent, give me basic services. Same with a short-term rental. If all you're getting is access to the facilities of the building and basic amenities, air, internet, heat, water,
no turn down service, no maid service, you're not going to probably be in the Airbnb, the UBTI world. You probably don't have to worry about it. Again, no debt. You can't use it personally or have a family member use it because that could trigger the prohibited transaction rules. Thus, the main source of focus should be on the nightly or daily services being provided to the tenant. If it doesn't look like a hotel, it looks more just like type of services you would provide to a regular renter, you're not going to be in the UBTI world. Follow up on the hotel question, what about storage facilities? Storage facilities are a little different because storage facilities is a business, right? Storage facilities, no one's living in it. The rent is a different type of rent than you would if you rented to a tenant to live in it. It's not really real estate rental. It's more of a service type rental. You are renting a space, but it's not your traditional real estate rental. And I've gotten a lot of questions on this. I have had a lot of great discussions with clients. There's also some guidance from the IRS and under 512 regulations that I can send people if you're interested about storage facilities. But it's really more akin to like parking garages than to renting out a apartment to a tenant, or even if it's an Airbnb short-term rental. So the storage facility, the way I've seen it, the way the IRS I think would come down on it is I think it would be subject to UBIT. So just something to consider. At that point, you may want to think C Corp blocker. What are my chances of getting audited on UBIT? So good question. Obviously, they'd audit the 990T because that would be the only way they know if you would be subject to UBIT. The 990T, the IRS does release statistic. It's very low. It's in the hundreds across the United States. So it's very, very low. I've actually never had a client audited on UBTI. So I don't think it occurs a lot because if you look at the statistics, and if people want numbers, let me know. I can actually send you the document from the IRS, but it's much lower than 401ks. Actually, IRAs, the IRS doesn't even provide audit numbers. They do for 401ks, defined benefit plans, defined contribution plans, profit sharing plans, and they do for 990Ts, but they're extremely low, even lower than solo 401ks. I've heard about structured transactions as convertible debt to get around UBTI. Is that true? So it's a good question. What's convertible debt? Convertible debt means you start off as lending the company money, and then usually the lender has the ability to convert that loan to equity at a certain point, or a certain price of the stock. If it's publicly traded, it's private at a certain period. Why do you want to convert? You want to convert because if I lent Uber $100,000 8 years ago, and now they're going to go public, I'd rather be a shareholder than a lender because shareholders have the upside of unlimited appreciation, where debt holders are capped on the amount of interest. So at that point, I would convert my loan to equity, and if it's an LLC, at that point, I'd have UBTI. So you got to kind of play that game and judge when you want to make that election. If you know for sure there's going to be a sale, you may want to do a debt to equity conversion. Again, but if there's UBTI underneath it, you're going to have to deal with UBIT. So the equity conversion may help you from a financial investment standpoint, but from a tax standpoint, it may not. But you may not care, because if you run the numbers and you say, listen, I invested $100,000, I'm going to do it a loan transaction. I got 10%, 10 grand a year, plus my 100,000. That's 100. Let's say over 5 years, I'm going to have $150,000. But I have a chance to convert this to equity, and maybe that $100,000 investment could be worth $1 million on a sale. You may want to say, okay, I'll just do a C Corp blocker at that point and be stuck with 21%. 21% on maybe $1 million of gain was going to leave me a lot more money than just $150,000 if I was a lender. So that's kind of the analysis you need to go through, and that's kind of another reason we're here, to kind of help you navigate those rules, and we can work with your tax professionals and kind of get you on the right footing so you can make the most educated decision and most tax efficient decision. Oh, I got a lot more questions, so I'm going to try to go through a bunch more. And if I don't get to all of them, I'm sorry. Actually, there's only 5 or 6 more. So let me see if I can flow through them. There's questions I'm receiving, so if I don't get to those, I will answer them the best I can.
If I invest in an S corp, do I have UBTI? Well, the IRA is not allowed to invest in an S corp. There's an S corp shareholder rules. Only individuals, single member LLCs can, and actually a 401k can invest in an S corp, not an IRA. So you're not, if you're an IRA invested in an S corp, you actually blow the S corp rules and you convert to a C corp. So whoever's managing an S corp would not want you to do that and probably would not allow you to invest. You'd have to convert. You would automatically blow their election and become a C corp. If a 401k invests in an S corp, you're going to trigger UBIT. So they might not be happy about that. What if I invest in daily rental properties? Would I be subject to UBTI? Again, that's back to the Airbnb model. If you're not providing paid service, you're probably okay, and there's no loan. What exactly do you mean by active trader business? So this is an amazing question, and I probably take for granted that I say active trader business, and in my head, I just kind of know what it is. It's like the eye test, like it's kind of like you know what you see, you know what it is. And I kind of I've been doing this so long, I kind of know what a business is and what it's not. For some, especially real estate investors, it's a fine line about what a business is or not. I know there's a lot of you out there that could have millions of dollars of real estate out there, but you file Schedule E. You may have a day job, maybe you're a doctor, a lawyer, an accountant, software developer, and you own a bunch of homes, but real estate is just kind of a passive activity for you. Or a hobby. It's not something that you consider yourself in the business. Where if I looked at you and I said, well, you own 15 homes and you have 3 employees in your operation, hey, that IRS may look at that as a business. That's just something kind of my eyes have been trained to do. So what's an active trader business? It's something, the easiest way to look at it, you're selling a service or a widget, right? You're selling coffee, you're selling legal services, accounting services. Those are the obvious cases. Real estate's the more difficult one because there's a lot of gray areas. I own 4 homes I rent out. Am I in business? You probably can take sides either way, whether you're Schedule C, Schedule E, whether you want to take deductions as a business or not. You probably can go both ways. If you're a developer and you are developing a project with 30 homes, yeah, you're probably in business. If you're developing, one beach home, maybe you're not in business, but you could argue you are in business and file Schedule C and take those deductions, but you would be subject to self-employment tax. So those are the real estate are kind of the areas you need to kind of think through, talk to your financial professionals, tax advisors, and kind of see what makes sense. Is it helpful to be a business, self-employment tax aside, versus maybe doing a solo K, getting the benefit of contributions to a plan, a benefit of exemption from UBTI tax, versus Social Security and FICA taxes. Just an analysis you got to run. You want to be accurate. Clearly, if you are in business, you need to treat yourself in business. If you have a storage facility and the code says you are a business, then you need to file maybe the 990T if there's profit. So you just need to kind of follow the rules and seek advice where you can. But there are situations where it's very gray. And you can potentially go to 5 different professionals and get 5 different opinions about whether you're in business or not. Just something you got to deal with. I wish there was more clarity, but it's not. It's very heavy on facts and circumstances. But those are really for the small case of real estate investments. Otherwise, it's pretty obvious. If you're selling a service or a widget, you're probably, or inventory-like widget, you're going to be in business. If I invest in an LLC, they'll be using a loan. Am I not acquiring the loan? I'm a passive investor. Will I still be subject to UBTI? So yes, if you invest in an LLC that owns a coffee business and it needs to go to Capital One to get a working capital loan, then yes, you're going to be hit with UBTI, assuming there's profit. So there's an important distinction. Your IRA is investing in the entity. Obviously, it's not the actual borrower, right? The LLC is the borrower. But since the LLC is a pass-through entity, it's kind of a tax invisible, right? It's there from a legal liability standpoint, so it gives you limited liability protection. So it exists from a limited liability corporate standpoint, but from a tax standpoint, it's not there. So from a tax standpoint, your IRA is basically getting the loan, even though the LLC is. So that's kind of one way of looking at UBTI. If that LLC was a C Corp or taxed, filed an 8832 election to be taxed as a C Corp, or just was a C Corp, then you would block the UBTI, right? Because a C Corp's a taxpayer separate from a shareholder. It pays its own corporate tax,
and a C corp is not a tax invisible because it's its own entity that's subject to tax, and that's the main distinction between LLCs and corporation, and why LLCs and other pass-throughs are subject to UBIT. Do you have a lot of clients that use C corp blockers? Now I do, a lot more than I did pre-18. Pre-18, I hardly had any. Now I have a bunch, and more are looking at it. Especially people are using a lot of leverage, especially active trader business investors that are investing their IRA into businesses that they think there's huge upside. They want to get into that C corp. Now, one thing I should mention about the C corp, in startups, a lot of times in the beginning years, there's not a lot of income, right? There's losses. If the startup gets sold, that's a capital gain transaction. That's not business income. And there would not be UBTI on the sale of stock or the sale of an LLC interest. That's a capital asset transaction. It's not subject to C corp. Excuse me. It's not subject to UBTI as long as there's no debt. So if you're investing in a startup and you think the exit strategy is a big sale and you don't have a lot of income yet, you may want to be okay. You may say, oh, I'm not going to do the C corp because I don't want to pay 21%. I'd rather sell the LLC interest and pay no tax because IRAs don't pay capital gains tax. They pay no tax. Traditional or Roth, right? You defer it. In a traditional sense, you pay tax when you're 59.5. In a Roth, you never pay tax if the Roth's been open 5 years and you're over 59.5. So if you're investing in a startup, active trader business, pass-through entity, your exit strategy is capital gains sale. You may not want the C corp, especially if there's not a lot of income. And if you believe you're going to sell this as a capital transaction, you're not going to be subject to UBIT. One more thing I want to mention, I didn't get a question about this, and I should have put it in, that if you sell your real estate, that's also capital asset. But if you sell real estate and there's a loan that's existing or has not been paid off within 12 months of the sale, your capital asset turns into a UBTI issue. So, right, if you buy stock, okay, if you invest in a startup and you sell, the startup gets sold, that's a capital transaction, no UBTI tax. But if you sell real estate, it's also a capital asset. But if there's a loan in existence or it has not been paid up 12 months prior to the sale of the real estate, you're still subject to the UBTI. Whereas in the case of a business, even if there's a loan there, you're likely not subject to UBTI because you're just selling your LLC interest. Whereas in the real estate sense, the acquisition indebtedness could get triggered. So it's something to consider. I've seen it both ways for startups. If startups have debt outstanding, usually on the sale, there's an issue. The debt gets transferred to the shareholder or to the buyer, or there's some repayment of the debt before the sale or at the sale. So the cases I've seen of my clients, there hasn't been UBTI in the case of a stock sale or an LLC interest sale, even when there's debt in the company or the LLC. But in the case of real estate, it's clear that in a IRA, if the real estate is sold in an IRA, it's a capital sale, but there's debt and hasn't been paid off 12 months prior to sale, you're going to be hit with the UBTI, even if you're selling the stock and not getting selling the real estate, and not getting the business income. In a 401k, you don't have to worry about it, right? 401k, there's acquisition indebtedness exception under 514C9. You can circumvent that issue, even if you sell the LLC interest, and there's debt outstanding. Who cares? Because 401ks don't pay tax on the debt. In the IRA world, if the debt's there on the sale, and even if it was paid off 12 months prior to sale, let's say 11 months, 10 months, 9 months, you're still subject to UBTI. If it's paid off 13 months, no UBTI. So it's something to consider of a C corp blocker in that sense. Okay, last one actually. If you have the 990T accountants help, we can help you do it. We have accountants that can help you do it. We offer that service to our clients. There is a fee depending on the type of service. If you want us to just look at the 990T, there's no fee if you pay our annual consulting. If you want us to file it, the accountant will charge between $250 and $500, depending on the work involved. But we do offer the services because I know there's not a lot of accountants that have experience in this area. So we're here to help you if you need help on getting support on 990Ts. Other than that, I got a lot more questions. I'm running up against the 2 o'clock deadline here on the East Coast. But let me try to get to one or two here. Hold on.
Okay, so let me get to these questions. So no UBTI if you, hold on, I'm not getting this whole, I'm not able to get this whole question. So no UBTI if you sell real estate in the solo K. That's correct. If you have a solo K and there's leverage in real estate, there's no UBTI. Next one, if you own debt finance rental income in your IRA, you only have UBTI on the profits. Right. If your rental income was $12,000, your mortgage $10,000, you had $1,000 of expenses, you would only owe UBTI on $1,000. If you put $1,000 towards extra principal payments, would you still owe UBTI? No. If you took that extra $1,000 bucks, probably can reduce it further by depreciation or debt payments. That's an expense. Debt financing is an expense. You can reduce your UBTI. That's a good example of one way to get around UBTI, as long as you have cash flow, right? You need cash flow to pay off the debt. Do you have UBTI on the sale of property when you do have a gain? In an IRA, if there's no UBTI on the gain, there's no gain, right? There's no tax on the gain. If there's UBTI and the loan is still there within 12 months on the sale of real estate, there is UBTI or UBTI tax. 401k, you don't have to worry about it. So in an IRA, there's no UBTI if there's no leverage. If there is leverage and leverage is there within 12 months of sale, there's going to be UBTI if there's gain. But again, you can take into account expenses or deductions. Okay, I got a bunch more questions I'm not going to be able to get to, so I'm going to try to answer those in a blog. My apologies. There's just so many. There's so much information on this stuff, and there's a lot of questions and a lot of great questions, and there's obviously a lot of interest because of the tax ramifications and the huge tax ramifications. You know, when you're looking at investing in retirement accounts, using retirement accounts for real estate, and you're expecting to pay no tax, and now you get hit with a 37% tax bill, not fun. So we need to find solutions to this, and my goal is to help clients where solutions are present to help present them to our clients so they can invest in the most tax efficient way. Again, this presentation, I appreciate everyone who's attended. There will be a recording available, a video available for anyone that's interested to review it. It'll be available to all those who are clients that pay our annual service, which thankfully are close to 90% of our clients. So all thousands, close to 10,000 of you will get to benefit from this recording. And Bergman, IRA Financial, again, thanks for watching, listening, viewing. If you have more questions, you can email them to us at info@IRA Financial. You can email me directly. You probably have my email if you're a client of ours. And I look forward to answering them. Thanks again for participating, and look forward to the next presentation.